as inflation begins to increase, consumers are going to try to save money. They're going to, spend less. I mean, a lot of them are trying to, take credit too, which I don't recommend.
It's a contraction of economic activity. The yield curve has been inverted.
Yeah, it's been over 660 days.
Are we saying that when it inverts, we're going to be in a recession? No. Regardless, being in the markets is better than trying to time everything. If your portfolio goes down, just know at some point it's going to go back up. Welcome back to Give and Grow. My name is Ryan. This is Eric.
What's up?
Two guys just trying to understand as much as we can so we can be able to build a great foundation for our family and be able to share it with y'all.
Absolutely.
We're not trained professionals. We're not financial advisors. We just like this stuff. We like to understand how to make money and how the economy works, which is actually going to be the topic for today, a topic in regards to the economy, which is recessions. We're going to be talking about recessions, like what they are, what causes them, and some misconceptions about them.
I don't want y'all to think we're just trying to be doomers every week, but
right.
we really just want to have a healthy conversation about what recessions are, and how to benefit from them ultimately in the long run, through positioning.
I wanted to start off today's episode by going over our question of the week, which is going to come from our boy Rob. Rob, I appreciate you providing this question, and we're going to get to it. And he asked, what are our thoughts on gambling?
Oh boy.
Yeah. Gambling is something that, I never really dabbled in gambling. I think that I'm afraid to lose money. It's not like I'm against it, but I'm kind of very wary about getting too involved. And I also mentioned too that I have a very 0 to 100 personality, so I might be in a position where I would just keep on just throwing money, trying to make it back or whatever, and I'll end up losing it all. But overall, gambling, I think that if you're, the addiction of gambling is a very tough thing to get over. I actually haven't gambled in a casino before. Now, I've gambled on stocks. And, I'm pretty sure that my record on gambling on stocks is because, I did a lot of the meme stocks back in the day, some other single stocks. And I think that I'm a little bit ahead. But then I was like, you know what, I'm just going to just cut this and just go to a much more traditional approach to investing. But what about you? What are your thoughts on gambling?
Man, I've been to the casino one time. I got lucky. I made $40 on one of the first machines I did, and I was out. Just kind of knowing my addictive personality, I've always tried to be very careful with gambling. And another, big, I guess, way of gambling is sports gambling now.
Oh, man.
I love sports, but that's something I have stayed clear of. I would rather be the house versus the opposite. You can view it through probabilities, but there's just so much stuff you can't control now, like poker and other things like that. If I were to ever do something like that, it would be with a very tiny percentage of my cash, So
right.
I think if you have I don't recommend it for anyone, but if you have a healthy relationship with it and you know when to get out, that's fine. But it's just not something I'd recommend for people. But I don't know. That's just my opinion.
Before we get into recessions, into our next kind of excerpt now, which is the things that we learned this past week. Something that I learned actually in preparation for this conversation with recessions is that the shortest recorded recession in history was the one in 2020, the pandemic recession. I was like, there's no way it lasts this long, but it was only 2 months long.
Yeah.
And traditionally, recessions last upwards of 17 months.
That's
16.
The average.
Yeah, that's the average recession. And some of them lasted longer, which those go into more like depression level time frames. But 2 months is not that long. And if you wanted to know why, it's because the Fed came and they basically stimulated the economy. They started to pump money back into the economy, and that basically bailed out the U.S. economy. So that recession lasted not that long at all. What did you learn this week?
Man, I'm always learning. I think the biggest thing I learned, and it's not necessarily related to recession, but just kind of studying the metals like gold and silver.
Oh yeah.
I learned that China is definitely buying a lot of gold. China and India, their central banks are. Some people think it's because they are trying to attack the dollar. Others think it's just for diversification because they do have a lot of bonds. And I think they might just be trying to diversify. So I just find that interesting. I think gold and silver are very interesting when it comes to time periods of high inflation. So, but yeah, that's, I mean, like I said, I've learned a lot, but I found that pretty interesting.
You know, people think about gold and like, oh, well, it's like it's like one of those commodities that like you kind of just buy during like inflationary periods. But I think that like you mentioned this to me recently, that if you took the S&P and gold and like put them together as far as their rates of returns over the past like 40 or so years, it's a lot closer.
Yeah, it's closer than you would think. Yeah, obviously, the S&Ps outperform, and it's just different because there's no with gold. It doesn't pay a dividend. It's not a business. It's not increasing in earnings per share every quarter. It's just literally supply and demand. Are more people buying it or are they selling it?
Well, it's also tangible. And
it's definitely passed the test of time.
Oh, yeah.
As a place to store your wealth.
Yeah, that's true. That's very true.
Keeping its value. So, yeah, the coins, the metals, I find interesting the more I learn about them. So.
Yeah, they're awesome. If you have any questions that you want us to talk about on here, if there's anything that you've learned that you wanted to share, please let us know in the comments. Once again, we're a place where we want to be able to share as much information as we can with everybody, and likewise we want to learn. Like this topic that we're going to be talking about today with recessions, if I were to have done more research back in the day about them, I probably could have taken advantage more of kind of like the times that we had within the past 4 or 5 years. But, if you start learning now, that will prepare you for the future whenever these things come back. So that's
absolutely.
That's just something that, we wanted to just throw out there. Let us know in the comments. Going into our topic, recessions. Recessions are something that come every so often. They don't come all the time, but there's something that if you're studying investing, if you're studying the economy, even your like day-to-day stuff, recessions affect your day-to-day. So the definition of a recession, it's a contraction of economic activity, whether it be through GDP, whether it be through the money flows, so people spending less money, there's less money going out. And it's kind of this time where, a lot of that activity is happening. If you want a technical definition of a recession in terms of the numbers, it's 2 consecutive quarters of negative GDP.
Yes, sir. Yes, sir.
So for example, like right now, GDP recorded at 1.6. Let's say it dropped below 0 and it was at like negative 1%. So a recession would occur if it was like -1 and then -1 again. So 2 consecutive quarters of negative GDP. GDP, if you don't know, that is a gross domestic product. That basically measures, the activity as far as like companies. If you're starting to see companies, their earnings statements aren't doing so well, you might be seeing yourself in a time where a recession might be coming around.
Yeah, I think it all starts with the consumer. Let's just take inflation as a topic. So as inflation begins to increase, consumers are going to try to save money. They're going to, spend less. I mean, a lot of them are trying to, take credit too, which I don't recommend.
Oh, yeah.
But eventually you can only do that for so long. Eventually, when you look at earnings per share with companies, because consumers aren't spending as much, those earnings per share go down. Because of that typically leads to unemployment. So that increases. And then eventually, you see the situation that we're in, 2 negative quarters of GDP. When I think about it, I don't think there were really a ton in the 90s, but I definitely remember, the great financial crisis. I remember 2001, the dot-com bubble. I know like technically 2020 was technically a recession. But man, they wiped that clean pretty fast.
Oh yeah.
They stimulated very hard on that one. So that's the thing. You never know when they're going to come.
Right.
I remember when 2023 started, we just came off a down year in the market. It was down like negative 20%. Everybody was like, oh my gosh, the world's coming apart, or, we're going into a recession. But actually, the economy ended up doing very well in 2023.
Oh, yeah.
The market went up, and, it's still going up this year. And this year you're hearing a lot of the same noise. So one big thing I've learned is just never assume when a recession is going to happen.
You mentioned inflation. So if monetary policy is like very, very light,
mm-hmm.
and then inflation starts to go up. So like, let's say like interest, like, I'll give you, we were talking about
for COVID,
about the COVID crisis. Policy was very, very low. And then COVID happened, they came back in and they stimulated it. And you were having periods of like, very, very low interest rates.
What a time to buy a house.
Yeah. It would have been a good time to buy a house. It would have been a good time to get into the market. But it's because of all of that stimulus that, inflation started to come back in like 2022. And what was their response to that? The response was to have a tighter monetary policy.
Now inflation in 2022, if I remember correctly, got up to 9%.
Yeah.
Is that correct?
The peak was like 9.1%.
Okay.
That was for CPI, which that's the consumer price index. That was at like 9.1%.
Wow.
And rates during that time were still very, very low. They started to increase interest rates. They were tightening their monetary policy by reducing their balance sheet, the Fed's balance sheet. The hope was that the rates would slow down economic activity in the hopes to lower inflation.
Yeah.
So that was basically what was happening in like all of like 2022. They raised rates all the way up to like 5.25%, and that's where we've been ever since the middle of 2023.
Yep.
We've had 5.25 rates. That's what they normally try to do to bring down inflation, and as a result of that, leading into like recessions, a byproduct of raising rates and those things is unemployment would go up, because, the less money that companies have, the less that they'll be able to pay employees for expansion. That's why you've been seeing a lot more layoffs. Now, the unemployment report over the past year or so has been staying very, very strong, which is why this year, going into 2024, you were seeing inflation kind of being sticky. There was like sticky inflation. Hyperinflation days are over, but the unemployment rate staying pretty much relatively low. That was a sign that the economy is still pretty much robust and strong. And it's why they haven't made any crazy decisions to cut yet, because they're like, okay, well, we can be able to potentially get rates down. We can potentially be able to get inflation down even further if we keep the rates high.
When we had that 9% inflation CPI, we hired interest rates, and now we're around 3.4.
Yeah. CPI right now is around like 3.4%.
Okay. And the goal has always been 2%.
But yeah, the goal has always been 2%.
And so in January, since January, we've seen a small uptick, I guess.
I think CPI got at least around the threes.
Yeah.
It was somewhere around there, but it's been slowly creeping back up. It got up as high as like 3.6, 3.5.
Yeah.
And then it dropped this last month to 3.4.
Okay.
People were planning for a recession in like 2023, but the job market was staying strong, and interest rates were still being increased. The thing is that economic activity ramped up insanely.
Yeah, and
in 2023.
Typically there's a lag effect with interest rates too.
There's like a lag effect. So really, that's what people are saying now, that the recession is kind of like around the corner, because GDP dropped from I want to say from 2023 going into 2024.
Mm-hmm.
GDP went from being in the negative to being over like 4%, revised probably down to around like the mid threes around there. And then this quarter one, it lowered from like the mid threes down to 1.6. So that's when people were having their like little, the flashing signals like, oh man, GDP is starting to come down again. And, rates are still high. The Fed is still tightening their balance sheet. The one thing that I'll say, which is a key indicator of a recession, is in addition to the 2 negative quarters of GDP, the inverted yield curve.
Yes, sir.
So what the yield curve is in like a nice healthy market is that the long term bond yield is higher than the short term, right?
Yes.
What normally is a sign of recessions is you have the short term bond yield producing higher than the long term.
And that's because the Fed has increased interest rates.
The yield curve has been inverted for a good almost like 2 years now.
Yeah, it's been over 660 days. I just saw on a podcast earlier, or listened to.
Right. So it's almost been inverted for 2 years. So are we saying that when it inverts, we're going to be in a recession? No. It's just something to, it's something to consider because
the lagging effect could lead to a recession.
Right.
And
exactly.
if you're older and you have your portfolio, I would recommend not being so heavily invested in equities at this time. I would definitely diversify more. I manage my mom's account, and it's just completely in a market money fund, just taking its 5% interest, and I'll just wait when equities become. When I see value in equities again, that's when I'll re-enter for her, but obviously not the full amount. So you do want to be careful if you're older. You want to be a little more defensive with your portfolio. But if you're younger, like I said, just keep DCAing every check.
See, that's kind of the crazy thing because, people consider like 10% a year to be kind of like, a nice historical return if you're in like the S&P or stuff like that. Mm-hmm. During these times, 5% in cash, you have no downside risk.
Yeah.
You're, it's sitting there, you're collecting the interest. So it's still pretty good. Really, I would say that like 7 to like 8% a year is like a normal return for like, if you take like, the market in general, with equities, cause you can be investing in like the Dow Jones or the NASDAQ or the S&P or even like small, the small cap, ETF,
IWM.
Yeah. IWM. You could be having like a diverse portfolio with a lot of these. You might be in some like very, very conservative, ETFs or like index funds. So 7 to 8% is where I normally would say is kind of like a normal average return. 5% is only 2%, like 3% lower than that.
And you can still utilize a portion of that cash if you're a more active investor, mm-hmm. and you could actually build yield on top of that by selling options, safely. And that's something we'll talk about on another episode.
Yield stacking.
We're starting to do that with silver ourselves. So you'll be able to kind of see how that works for us.
Over the next
for the rest of the year.
Right. Some things that I wanted to bring up to kind of like land the plane with recessions is that they're not always a negative thing. I think that people think about recessions. I think some of the things that are like very, very negative, which it's just a part of how things are, unemployment being higher, inflation is probably going to be higher during recessions, which means that they have to increase rates. It's harder to borrow money. That's why, buying a house right now is so expensive, mm-hmm. Because the rates are so high. Which you can always marry the mortgage, date the rate, and you can refinance. But that's just something that is just like a reality of recessions. And if the average historical span of a recession is like 16 months, you're looking at like a year and a half. Kind of like what we said a while ago. Plan for the feast, plan for the famine. During these times, it might be a good idea to think about kind of like what he was saying. You want to consider maybe increasing cash reserves. You want to consider, if you're in kind of like a riskier portfolio, you can like reduce that, go into cash, go into, even going into something like precious metals, gold, silver, low key Bitcoin. I'm not gonna lie to you. I think Bitcoin overall could be a really good hedge against inflation, because you think about people coming out of the markets. You might be able to go into something that's not really tied to like GDP, tied to like companies. It's more its own separate thing. But that one's a bit more that one is a bit more risky. So like cash, those kinds of things are like really good. Just prepare for when the time would come back, because it's always going to come back. Warren Buffett talks about this all the time. He said this earlier, like, you never want to time these things, as long as you're being mindful of like your positioning. There's going to be a time for you to be able to have more cash. There's going to be a time for you to start loading back up on stocks. Regardless, being in the markets is better than trying to like time everything. And, if your portfolio goes down, just know at some point it's going to go back up.
Yes, sir.
It's always going to go back up. Historically, over the past 100 years, it's been nothing but a slow incline. So
yeah,
you never want to just be like, oh well, I'm never going to believe in the economy again. I'm just going to go all in cash. You technically could do that, but you're probably going to be missing out on some opportunities. Oh, yeah. You want to work on yourself. Unfortunately, if you are a person that is affected by layoffs during these times, it might be a hard time, but don't give up hope. Like, there's always going to be opportunities for you to be able to sustain yourself. Don't think that the sky is falling when there is a recession, because it is going to end at some point. Now, unless we're in some like crazy depression like stage, where it can last longer than those 16 to 18 months, that might be a time where maybe have to like sacrifice a little more. You're always gonna come out of it, because one thing that I know about the Fed, and one thing that I know about the government, is that it's their job to make sure that we are always gonna be taken care of. Not like us personally, but the economy in general. Like, they're always gonna make sure that like we're gonna be figuring out ways to keep us all at least in a state where we're not going to be crashing hard. You know what I'm saying?
Yeah. And like you said, kind of land the plane. Something else to think about, a time period that's very comparable. And, history is never the same, but it does rhyme. But a time period that's very comparable to what we're about to go through potentially was kind of the 70s. You had high inflation throughout the decade. You had interest rates going up, then down. You had inflation going up, then down. Then it shot back up. Interest rates had to shoot back up. Eventually, it got under control. And that was a long period during that time. But you know what? It created opportunity.
Right.
If you had the cash available, you were able to keep DCAing, keep buying, and then after that period, over the next 40 years, if you kept doing that, buying stocks, buying real estate, if you're a boomer, you had that mindset,
yeah,
you were probably very wealthy right now.
Oh yeah.
And so these things have to happen. There's cycles. Could it last? Could this be a decade thing that we're going into? Possibly. I don't know the future, but you want to prepare for it either way, just to be safe. Nothing goes straight up, nothing goes straight down. But I think we are entering a different time period. Some people call it the fourth turning. But like I said, I'm not here to be a doomer. I'm here
What's the fourth turning?
Well, basically, when you look at cycles, I've never like studied this like insanely deeply, but to my very superficial understanding, it's when cycles get very intense. You have a very high likelihood of civil war, possibly.
Ah, I see. Okay.
Usually, it's when empires typically fall. Bigger attacks on the dollar. A lot of geopolitical things going on, higher chance for world wars, stuff like that.
Yeah.
So we're kind of around those periods. We're kind of, but that's the thing. No one knows for sure. I mean, people always call for doomsday every year. There's always someone or groups of people. So yeah, I mean, there's going to be tensions, and we might get some wildfires over the next decade. But
Right.
you know, to handle these things, you know, as a country, as people, politically, eventually we have to come together for the issues that are potentially coming up.
Right.
So, but my big thing is keep building that cash, keep budgeting, keep learning, value education, and opportunity will be there.
Oh yeah.
You'll be able to take advantage. That's how true wealth is built. You know, when everybody else is freaking out and running away and being fearful, that's your time to be greedy. And it might be a short period. We go up a little bit, right back down. Just keep buying.
Oh yeah.
I know I sound like a broken record today. But,
no, that's.
it's going to be fun to see how this. Not fun, but it's going to be interesting seeing how this works out over the next decade.
Oh yeah, that is basically the big thing. You know, never stop investing, never stop thinking about these things. If you don't think about it, then you're going to end up you're either going to miss out on the opportunities,
yeah,
or you're going to be someone that thinks that the system is just not working.
Yeah,
you know what I mean, but. If you don't do the research, you know, you're not going to know that over the past 100 years, even though the dollar has lost a lot of its value and stuff like that, you know, you pick a lot of these times, and then over time, because investing was never meant to be, oh, well, I'm just going to make millions very, very quickly. Like, it's always this very, very slow thing. And, you know, compound interest is the key, and compound interest, one of the components of it is time. Like, you need a lot of time for it to actually start to do. You need money and you need time.
And the law of large numbers too.
That's right. That's what it is.
Critical mass.
Critical mass.
I love it, man. I love it. I really enjoyed this episode. A lot of good information.
Oh yeah.
Good stuff.
Yeah. If y'all have any thoughts about recessions, if y'all have anything that you wanted to correct us on, if there's something that you learned about it, you know, if there's a question that you want us to talk about on the next one, just let us know in the comments. If I can ask you to please like the video, subscribe to the channel, turn on the notification bell. We would love for y'all to do that. It really helps us out. Yeah. Is there anything else you want to say before we close it out?
No, guys, we love y'all. Until next time, let's continue to give and grow.